Israel strikes Iran. Within hours, the story spreads across major networks. Analysts begin weighing in, and conversations shift from regional tension to the possibility of something wider. And after the initial shock settles, a more practical question begins to form. Okay, what does this actually trigger? Is this another episode in a decades-long rivalry? Or is it the kind of moment that quietly changes financial conditions far beyond the region itself? Because history suggests that when tensions escalate in this part of the world, the effects rarely remain confined to the battlefield. They move through markets, through currencies, and through the financial system that connects economies thousands of miles away. And sometimes, the consequences surface in places that seem far removed from where the conflict began. To understand why, we have to go back. Iran and Israel were not always open adversaries. Before 1979, the relationship was pragmatic and largely strategic. The Iranian Revolution changed that. A new ideological framework reshaped Tehran's regional posture, and Israel became a declared opponent rather than a quiet partner. Over the decades that followed, confrontation unfolded indirectly through proxy groups, covert operations, and carefully measured escalations that avoided full-scale war. But February 28, 2026, felt different. This time, the exchange was direct, and the possibility of sustained retaliation suddenly became real. President Masoud Pezeshkian had insisted for months that Iran would not bow to outside pressure. From Tehran's perspective, projecting strength protects leverage. It signals resolve. It reinforces deterrence. Political leaders think in terms of position and power. Financial systems think in terms of risk and duration. And when the perceived duration of instability increases in a region deeply tied to global energy and trade, capital begins to reposition almost immediately. Energy is priced in US dollars. Global trade is settled in US dollars. A significant share of international debt, particularly across emerging markets, is denominated in US dollars. So when escalation raises uncertainty, shipping companies increase cash buffers, commodity traders face higher margin requirements, importers hold larger liquidity reserves, and banks reduce exposure to perceived risk. All of those adjustments increase demand for dollars at the same time. When global demand for dollars rises quickly, liquidity tightens elsewhere. Emerging market currencies weaken, credit spreads widen, growth expectations soften. Over time, that tightening can reevaluate into the United States through higher borrowing costs, earnings revisions, and market volatility. The strike may be regional, but the financial adjustment it sets in motion is not. And that is why this moment may matter far beyond the headlines. If you look back through history, financial stress in the Middle East rarely begins with physical shortages. It begins with anticipation. In the 1970s, rising tensions among oil-producing states moved markets long before production statistics confirmed disruption. The expectation of instability alone was enough to alter capital flows. In the 1980s, during what became known as the Tanker War, ships continued to move. Oil was still extracted. Ports remained open. Yet the cost of moving that oil climbed. Insurance premiums surged. Shipping firms recalculated routes. Banks demanded stronger guarantees before financing cargo. Even without a collapse in output, the financial layer of the system tightened. Trade did not stop overnight. It simply became more expensive. And when the cost of moving energy rises, the adjustment spreads quietly across balance sheets around the world. This pattern has repeated in later flare-ups as well. Limited strikes, sanctions, threats of retaliation. Each time, the financial system responded before physical shortages appeared. Because markets do not wait for confirmed damage. They respond to the possibility of prolonged instability. And that response can be enough. Credit edges higher. Currencies shift. Margin requirements expand. Volatility increases. These adjustments often begin while oil continues to flow and supply chains appear intact. But once capital repositions, reversing that shift is far harder than triggering it. That is the subtle escalation most people miss. Before headlines confirm shortages, funding conditions can already be tightening. And that brings us back to February 28th, when Israel struck Iran and retaliation followed. The visible story was military. The financial question was different. Not what exploded, but how far does this extend? Because if this moment follows the historical rhythm, then the most immediate consequences may not show up in shipping data or production numbers. They may show up in currency markets, in the credit spreads, and in the global demand for dollars. And those effects can travel much farther than the battlefield itself. History tells us that markets reprice risk before damage appears. February 28th was one of those moments. Not because oil stopped flowing, because duration suddenly became uncertain. Within hours of the strike, oil futures moved sharply higher as traders priced the possibility of escalation rather than confirmed shortages. Implied volatility in crude markets climbed to levels not seen in months. The reaction was not about what had already happened. It was about what might continue. At the same time, currency markets began adjusting. The US dollar index strengthened as capital rotated toward perceived stability. Emerging market currencies softened, particularly in energy-importing economies. In credit markets, spreads widened as investors demanded additional compensation for uncertainty. High-yield debt felt it first. Nothing had broken, but the cost of positioning for risk had risen, and that is where the mechanism turns. Energy is not just a product that gets consumed. It sits at the center of financing chains. When escalation increases uncertainty around transport and settlement, shipping firms expand liquidity buffers. Commodity traders face larger margin requirements. Importers secure additional working capital. Banks quietly reduce regional exposure. Each of those decisions happens independently, but together they create pressure. And in global trade, pressure is measured in dollars. Energy contracts settle in dollars. Trade finance clears in dollars. A large share of debt outside the United States must be serviced in dollars. So, as uncertainty rises, demand for dollar liquidity rises with it. That demand does not announce itself dramatically. It shows up in swap costs, edging higher. Cross-border funding is becoming slightly more expensive. Corporate treasurers are holding more cash than usual. Central banks are watching exchange rates more closely than they did the week before. It is not a freeze, it is compression. And compression is often more dangerous than collapse because it builds quietly. As the dollar strengthens, countries with dollar-denominated obligations feel the strain first. Their import bills expand. Debt servicing becomes more expensive in local currency terms. Policymakers are forced to choose between defending their currency and preserving domestic liquidity. Corporations exposed to global trade begin adjusting forecasts. Multinationals consider currency translation impacts. Investors reprice earnings assumptions, not because factories have shut down, but because funding conditions have shifted. The battlefield remains regional, but balance sheets begin tightening across continents. And once capital has repositioned around higher risk, reversing that shift requires more than calming headlines. It requires certainty. That is the dollar mechanism in motion, and once it begins, it rarely stays contained. Global tightening rarely stays offshore. It travels. When the dollar strengthens and funding conditions compress abroad, the first strain appears in emerging markets. But it doesn't stop there. Nearly 40% of S&P 500 revenue is generated overseas. When foreign currencies weaken against the dollar, those overseas earnings translate into fewer dollars on corporate balance sheets. Sales can remain steady. Demand can hold. Yet reported profits shrink because exchange rates moved. That is the first channel. The second runs through credit. As risk premiums rise globally, U.S. corporate borrowing costs edge higher. Credit spreads widen. Refinancing becomes more expensive. Companies delay investment decisions, not because they are collapsing, but because capital has become less forgiving. For highly leveraged firms rolling over debt, even small shifts in rates matter. For small businesses relying on floating credit lines, tighter conditions are felt quickly. None of this requires a crisis. It only requires compression. The third channel touches households more directly. If energy volatility persists, Gasoline prices fluctuate. Transportation costs ripple through goods. Mortgage rates respond to shifts in treasury yields and risk premiums. Auto loans, business credit, and refinancing decisions adjust at the margin. Individually, these changes feel manageable. Collectively, they slow momentum. Investors revise earnings expectations. Equity markets reprice future cash flows. Volatility rises as uncertainty extends. And here is the paradox. When global capital tightens, the United States can look comparatively stronger. Money flows toward treasuries. The dollar appreciates. But that strength carries consequences. A stronger dollar weighs on exports, pressures multinational competitiveness, and reinforces the earnings squeeze it helped create. The same force that attracts capital can quietly constrain growth. This is the boomerang. Escalation abroad, tighter global liquidity, stronger dollar, earnings pressure, and slower domestic momentum. Not overnight, not through dramatic headlines, but through balance sheets, borrowing costs, and the steady repricing of risk. The strike may have occurred thousands of miles away, but the system that links trade, energy, debt, and capital does not recognize distance. And when liquidity tightens at the center of that system, the effects tend to circle back home. Whether this moment fades or deepens will not be decided by a single headline. It will be decided by time. Financial systems can absorb shocks. What they struggle to absorb is duration. If escalation cools quickly, if retaliation remains measured, and diplomacy lowers the probability of expansion, risk premiums soften. Oil volatility settles. The dollar's upward pressure eases. Capital relaxes. But if tension stretches, if new actors enter, if rhetoric hardens, if positioning extends, then markets begin to adjust not for shock, but for persistence. And persistence changes behavior. Energy does not need to spike dramatically to matter. It only needs to stay elevated long enough to embed itself in transport costs, supply contracts, and inflation expectations. Once that embedding begins, central banks face a harder trade-off. Tighten too much, and growth slows. Ease too soon, and inflation lingers. At the same time, investors reassess leverage. Balance sheets that felt comfortable under stable conditions begin to look less forgiving. Refinancing schedules matter more. Risk appetite narrows quietly. This is how tightening becomes self-reinforcing, not through panic, through accumulation. If capital senses that uncertainty has a longer shelf life, it demands compensation. If compensation rises, borrowing costs rise. If borrowing costs rise, growth expectations adjust. And once expectations shift, they influence behavior in advance. Right now, the system is deciding how expensive uncertainty should be. That is the fork in the road. If escalation remains contained, compression reverses gradually. If it lingers, capital reallocates more permanently, and once allocation shifts at scale, it does not reverse easily. Markets do not ask whether conflict is justified. They ask how long it lasts. And the longer the horizon stretches, the more liquidity tightens. The battlefield may determine headlines, but duration determines capital. Most geopolitical escalations do not end with a dramatic resolution. They fade. Headlines move on. Markets stabilize. Oil retraces. Volatility compresses. Analysts revise their forecasts again. In many cases, the system proves more resilient than the fear surrounding it. Trade continues. Capital adapts. Supply chains reroute. Liquidity returns. History is full of moments that felt decisive in real time, but left only modest footprints in financial data months later. That is one possible ending. But there is another kind of ending, not loud, not catastrophic, just structural. Sometimes what survives a moment of escalation is not the shock itself, but the adjustment, a slightly higher risk premium, a slightly stronger dollar, a marginally more cautious lending environment, a quieter shift in capital allocation towards stability and away from leverage. These shifts rarely reverse completely. They settle into the background, And over time, they influence decisions, corporate investment, household borrowing, sovereign policy, in ways that are difficult to trace back to a single date on the calendar. That is how cycles turn, not through collapse, through accumulation. The February 28th strike may ultimately be remembered as a brief flare in a long rivalry, or it may mark the point when global capital began pricing the world a little differently. That difference might not show up as a crisis. It may show up as slower momentum, tighter funding, and a more expensive cost of uncertainty. The battlefield determines the narrative, but the balance sheet determines the legacy. And long after the headlines fade, what remains is not the explosion, but the pricing.